Hi everyone, this is Mike Torres from VERTEX-FX. Today we'll be talking about the MACD, Moving Average Convergence Divergence. First, with disclaimer, today's training is designed to instruct in some of VERTEX-FX charting program. We will be providing some guidelines for using certain features in the software. However, nothing in this training should be intended as or should be construed to be a recommendation to buy or sell any specific security or currency. The information, technical analysis techniques and software presented today should be used by investors who are aware of the risk inherent in the trading. VERTEX shall have no liability for any investment decisions and trading strategies or any information provided in connection with the company. So let's start today. This is the system. We just press on chart, add indicator, and we go to the oscillators. As you know, the MACD is an oscillator. I like the reading 12 on the MACD, so we add the reading 12, then we add a line here and double click on it and make it a 0 line. Double click on the line, just enter the value 0 because it should be the 0 line, and we apply. Let me give you a briefing about the moving average convergence divergence. It was developed by Gerald Apple. It's one of the simplest and most reliable indicators available. It uses moving averages, which are lagging indicators. There are three ways for bullish market to identify bullish market using the MACD, and three ways to identify a bearish market for the MACD. First of all, we have a positive divergence, then we have a bullish moving average crossover and bullish center line crossover. First of all, I'll start talking about the center line crossover. The center line, I'll just put a note over here on the 0. It's called the center line. It's the center line. So we just add a center line, and so you can remember it's the center line here. You have the blue line and the red line also. So now the market is trading in a range. As you see, there was a crossover over here. The blue line and red line crossed over the 0 line. It confirmed that there was a trend. So many traders just use the crossover above the 0 line. So they buy here. Look at the distance between the blue line and the red line. There's some a nice distance, and the gap is here. The distance is small and it's expanding, and it goes through the 0 line with an expanded distance. It confirms that there is an upward movement. So many traders buy above the 0 line here. So they will be buying around these levels, and as you see, the market moved up. Now let's go across over under the 0 line. So traders will actually sell the market around these levels because it's crossing here, and you see that the market actually dropped. So this is the 0 line crossover. There's something also regarding the 0 line crossover. If the market approaches the 0 line and fails to cross above it, it indicates that the trend will resume. Let me explain this to you on the chart. It's easier for me to explain it. Here, the market was dropping. It tried to go through the 0 line over here. It failed. The fact that it failed to go through the 0 line, it gave us that the market will resume an upward trend. And here they crossed, and they crossed upwards, and the market actually moved upwards. Let me go on a negative one. Let me find the negative one. Okay, let's see over here. Here the market tried to cross above the 0 line. It didn't reach the 0 line. It failed to reach the 0 line, so the market actually dropped. Here again, it tried to go through the 0 line. It couldn't go through the 0 line, and the market dropped. Once the market crossed above the 0 line, it confirmed that there is an upward move. Here, it tried to go through the 0 line. It didn't, and the market went higher. You see, the fact that if the market tried to go through the 0 line and couldn't go through the 0 line, it confirms that there is a trend, or the market will resume the trend. Now let's talk about the bullish moving average crossover and bearish moving average crossover. Usually I don't look at the crossovers that are close to the 0 line. I like them to be really far from the 0 line. So if I look at the chart this way, these are the ones that I like to look at when the market is really above the zero line by a distance, and if they cross over, you see the red is above the blue, and the market here didn't go in a downward trend, but it stayed in a range. So it can either stay in a range or go in a downward trend. Here also it crossed upwards, but after a very sharp drop for the pound. You see the pound had a very nice drop here. It crossed upwards. It can indicate either that the market is going to trade in a range or there will be an up move. And the last thing we're going to talk about is the divergences. Let me pick a couple of divergences for you to see. I saw one over here. Let me see. Okay, this is a nice divergence. Here the market was trading at a low, and the MACD had a low. The market had a lower low, but the MACD had a divergence, had a higher low, and this confirmed that the market is actually going to move in an upward trend. You see there's this line, you see the line is going like this, and if we used this line over here, you see the market was dropping and the MACD was moving upwards. So best of luck in trading MACD. I hope that this small briefing about the MACD was beneficial for you all. Thank you very much.